past 3 years, Palantir Technologies has transformed from a niche data analytics company into one of the most talked about artificial intelligence stocks in the market. It has become a stock that divides opinion sharply, and both sides of the argument are very vocal. On one hand, skeptics continue to focus on its high valuation and warn that the share price is far above what traditional fundamentals justify. They believe that the market is pricing in unrealistic levels of future growth that may never materialize. On the other hand, bullish investors argue that Palantir's expanding reach across government agencies and enterprise clients makes the company's current premium valuation acceptable. They see the adoption of Palantir software as proof that the company has a strong runway for growth, and they believe this validates its elevated stock price. Adding to this ongoing debate, equity research analyst Mariana Perez Mora of Bank of America recently raised her price target for Palantir to $215 per share. That represents about 20% potential upside compared to the stock's level on September 25th. A change like this naturally generated a lot of attention because it stands out in contrast with the cautious sentiment of others. Mora's reasoning is especially interesting because she framed her argument in a very straightforward way, saying that if the software works, then it is not overpriced. To put this into perspective, let us look at her arguments in detail, compare them to other notable opinions, and then consider Palantir's valuation profile to decide whether this stock looks attractive for investors at today's prices. Palantir's financial performance has certainly been one of the key reasons why it continues to draw attention. The company has not only managed to grow its revenue rapidly, but has also demonstrated the ability to make that growth profitable. This combination is rare in the software as a service sector because many companies can deliver strong revenue but struggle to consistently generate profits. Palantir's growing efficiency in turning sales into lasting profits sets it apart and puts it in a select group within the industry. However, financial numbers only tell part of the story. The more compelling part comes from understanding where this growth originates. Palantir's artificial intelligence platforms, which include Foundry, Gotham, and Apollo, have been central to several major contracts signed in recent years. For example, the United States Army agreed to a deal worth as much as $10 billion over the next decade. Another significant win came from the United States military, which expanded its Maven Smart System partnership by $795 million, bringing the total value of that agreement to about $1.3 billion. Palantir has also built strong international relationships, such as its partnerships with the North Atlantic Treaty Organization. One of the most notable deals included a $1.5 billion partnership with the United Kingdom. These contracts are not just impressive because of their size. They also provide Palantir with long-term revenue visibility and stable cash flow, which are highly valued by investors. Companies that can show consistent long-term income streams often trade at higher valuation multiples because the market assigns a premium to predictable cash flows. Mora's perspective is also noteworthy because it pushes back against the criticism from other technology leaders. Salesforce Chief Executive Officer Mark Benioff, for instance, claimed that Palantir's software is too expensive. Mora countered this by pointing out that if Palantir's tools deliver results and create value for clients, then the price is justified. This idea is not entirely new because it echoes a similar argument from financial commentator Jim Cramer, who recently claimed that Palantir stock looks inexpensive when measured by its Rule of 40 score. The Rule of 40 is a framework often used to measure the balance between revenue growth and profit margins in software businesses. Palantir's ability to score well on this metric has given some analysts confidence that the company deserves its higher valuation. Still, when you shift the focus to valuation, the picture becomes more complicated. Palantir currently trades at a price-to-sales ratio of 133, which is dramatically higher than nearly all of its peers in the software-as-a-service space. A ratio at this level signals that investors are paying a premium multiple for every dollar of revenue generated. Even if Palantir executes its plans flawlessly and achieves its growth targets, its valuation would still remain far ahead of its competitors. When you consider that the company's market capitalization is already around $430 billion, it becomes clear that the stock is priced with extremely high expectations. This naturally leads to the question of how much future growth is already built into the current stock price. Some prominent investors believe the answer is that that nearly all of the growth is already priced in. Billionaire money manager Stanley Druckenmiller and his firm Duquesne Family Office recently sold their entire stake in Palantir. This was likely a move to lock in profits after the stock's dramatic rise. When experienced investors like Druckenmiller exit completely, it raises concerns about whether the upside potential from here is worth the risk of staying invested. From my point of view, it seems inevitable that Palantir will eventually experience a pullback. No stock rises in a straight line indefinitely. Markets go through cycles, and companies with lofty valuations tend to face sharp corrections when sentiment changes. If Palantir undergoes such a correction, its stock could fall significantly below today's levels, and there is no guarantee of a quick recovery. Right now, Palantir stock looks priced for perfection, meaning the market is assuming the company will continue to execute flawlessly without any setbacks. This is always a risky assumption because no company is immune to challenges. For momentum traders who thrive on riding short-term moves and are comfortable with heavy volatility, Palantir may still look appealing. Essentially, Palantir Technologies has become one of the most divisive artificial intelligence stocks over the past 3 years, with critics pointing to its extremely high valuation, while supporters highlight its rapid adoption across governments and businesses. Recently, Bank of America analyst Mariana Perez Mora raised her price target to $215, arguing that if Palantir's software delivers results, it is not overpriced. The company has secured massive long-term contracts, including a deal with the United States Army worth up to $10 billion, a $1.3 billion expansion with the United States military, and a $1.5 billion partnership with the United Kingdom, which give Palantir reliable revenue visibility. However, the stock trades at a price-to-sales ratio of 133 and a market capitalization of about $430 billion, levels far above peers, leading some investors like Stanley Druckenmiller to sell their positions entirely. While short-term traders may still ride the momentum, for more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.